Hello everyone, today's video is all about the rules on buyback of own shares. So company buyback of own shares. Now, I've done a recent video on this topic, but this particular video is rather a precautionary tale on what not to do, how you can get it wrong. And it's all about making sure you stick to the rules. So let me explain. So there was a husband and wife company. They were both director shareholders, and they were looking to sell their company. Now, this company had a load of cash in it, so it had well over £1 million of cash. Now, what is quite commonplace in the M&A world when people are buying and selling companies is that you've got a choice of what to do with the cash in your company that you're going to sell. Because if you strip it out before you sell it, chances are you're going to pay tax at high rates, and it's going to be taxed as a dividend. So you pull it out as a dividend, you're paying tax at 38%. However, often what vendors will do is they'll say, look, we'll wrap it up into the deal, we'll sell our company with the cash in the company bank account, and therefore we will get we'll basically get more for the share price because the company is laden with all that cash, and in effect we're getting our hands on that cash at 10% entrepreneurs relief. Now, yes, the entrepreneurs relief rate, the limits has come right down from 10 million to 1 million, but that was the gist of it. And that's how it's been gone for many years. People saying, you know what, rather than strip out pre-sale cash, we'll just add it on to the sales price so that the buyer can pay us more because there's all that cash in the company. Not only are they paying for the goodwill of the business, but for the cash, and therefore it will be lumped into their share sale, and they'll pay entrepreneurs relief at 10% on the lot rather than strip it out as a dividend. Makes sense. So you're paying 10% in effect on that cash rather than 38%. So this cautionary tale I'm about to tell you, a recent court case. So guy went to buy this company from a husband and wife laden with cash. And this is exactly what they did. The husband and wife said, look, we're not going to strip this cash out. We'll just add it on to the sales price of the company. So you effectively, it bumps up the sales price for the shares. You pay us more to the tune of what the amount of the cash that's in the company. And therefore, they got their entrepreneurs relief to the husband and wife when they sold the company. So the guy that bought the company, he's now the sole shareholder, and he's got this company, and it's full of cash. But he then said, well, I want to get my hands on this cash. Now, he thought, because exactly the same reasons, he didn't want to pay the 38% as a dividend distribution on getting his hands on the cash, like the husband and wife team that sold the company, but they had the correct way to go about it, which was to say, look, increase the sales price of the company and we'll get the cash out that way. In effect, I mean, the cash is still in the company, they're just getting a higher sales price. But the guy who bought the business said, actually, you know what, I like the sound of me getting my hands on the cash in the company as the new owner, and I want to get it out at 10%. So, but he's just bought the company, so he can't, he's not going to sell it again in quick succession. So he thought, okay, well, I know there's this rule, this purchase of own shares, where the company can buy back shares from the shareholder. That's a way to get your hands on some cash. So the shares were £101 shares, quite typical in small SME businesses. And so what he did, he got the company to buy back 99 of those 100 shares. So remember that couple of million that was sat in the company bank account. Basically, he said, right, I will sell 99 of my 100 shares back to the company that I've just bought for the 2 million cash that sat in the company bank account. So the company paid him 2 million for the 99 shares, and he claimed his entrepreneur's relief at 10%. This is before they changed the rules, of course, from 10 million to 1 million on entrepreneur's relief. But he thought, well, that's a pretty good bit of planning. I'll go ahead and do that. HMRC got wind of that and said, no, not going to work. And they slapped him for tax bill best part of £1 million when he thought he was going to get something like 200 grand. Why? Because the rules for buyback of own shares, there are certain hoops you have to jump through. One of them being that you have to have owned the shares for 5 years. Now, this guy owned the shares for like 5 days. I mean, not 5 years. So he didn't qualify, because even though had he have waited for 5 years after he bought the company and then done that, then that might have been okay. But the fact he tried to do it in quick succession, the HMRC said, look, you have to have had the shares for 5 years before you can get capital gains tax treatment on a share buyback from the company. So then, an interesting argument, the guy then said to the court, he said, look, you need to look at this in the round and say, well, actually, think about it. In terms of the husband and wife and me, the end game is the same. If you don't break down the fact that I bought the company off them and then we did the buyback, just look at it as if there is a company that's been around for more than 5 years and the company bought back shares from a shareholder. A cute argument. The revenue said, no, it doesn't work like that. You do have to look at each step in isolation in this instance, which actually is quite ironic, because a lot of tax planning over the decades tends to be around big ticket tax planning, where people come up with ingenious ideas. They do insert what we call contrived steps into tax planning, and these steps often give rise to a certain result that the taxpayer wants. And HMRC's defence, it even has a name. It's called the Ramsey approach, after a court case in the early 80s with a Mr. Ramsey. And HMRC's defence on the Ramsey principle is to say, look, forget all these contrived steps. You've got to look at the thing in the round. And if it, you've got to look at it, and is it tax avoidance? Does it all stack up by looking at it as one composite transaction, not individual? So in effect, this was a reversal, and normally it's HMRC always adopt that approach, and often the taxpayers come up with these steps to try and save tax. And in this case, this guy used it as a defense. He said, look, you need to look at this thing in the round and not look at each individual step, which is rather ironic, because it very rarely happens that the taxpayer would argue that. It's normally HMRC. But in this case, that's what he did. He said, look, you need to look at this thing in the round. We've got a company that's been around for 5 years, and we've got a purchase of own shares from the company, so capital gains tax treatment should apply. Very cute. Unfortunately, didn't work. Ramsey principle, as it's called, defeated. His argument was defeated, and the tribunal said, and it went all the way up to the upper tier, first tier, and the upper tier said, look, no, you've got two separate deals here. You bought shares of a husband and wife company for X pounds. They sold out. They got the 10% entrepreneurs relief. You then had a company. Yes, it was full of cash. And then a separate transaction, nothing to do with the original one, where you try to buy back the company's shares that you newly acquired to try and claim 10% to get your hands on this cash yourself. And I'm afraid it doesn't work. So nice try, but again, it on the face of it, it was destined really to fail, because that is a very simple test. It's there in black and white in the rules. Have the shares, have you owned the shares for 5 years? Yes, the company had been in existence for 5 years, but it'd been owned by the other couple for all of those 5 years. This guy had owned it for 5 minutes, so he himself had not owned the shares for 5 years, and so the purchase of own share rules wouldn't have applied to get his favourable treatment. And the default position when that happens, because remember, it's still lawful to do a company buyback of shares, that's fine, you can do that, it's just the tax treatment is different whether or not you've held it for 5 years or not. So the tax treatment follows income tax rules, not capital gains tax. Therefore he was hit for 38% of tax, not the 10% that he was hoping for. So just a cautionary tale there on purchase of own shares for SME businesses. Tip is simple: know the rules, play by the rules. Don't try and be cute. When rules are that straightforward, very prescriptive. There was no ambiguity in the law in this particular area. Yes, in other areas of the tax law, it's open for debate. The law isn't that clear, but the law in this instance is black and white. Have you owned the shares for 5 years? If you haven't, then you're going to get taxed as an income tax distribution. If you have, then fine. Step forward and hopefully get your 10%, as long as the other hoops are jumped through as well. Because remember, that's not the only condition of getting 10% tax on a company buyback of own shares. There's other things as well, but it's a non-starter for sure if you haven't at least ticked the box on the 5-year requirement. So just a video there on pitfalls of purchase of own shares and trying to get that elusive capital gains tax treatment that a lot of entrepreneurs will try and get in substitute instead of income tax treatment, which is obviously a lot more expensive. So if you like this video, please do subscribe right there, and I will see you soon.